Hey everybody, welcome to our webinar today titled All About Interest Rates. We're going to be talking about interest rates and inflation and how they're related to each other. This webinar will take about 20 minutes, so we'll leave you the large chunk of your lunch break to relax. If you have any questions while we're going through things, you can type them in. If you go to the bottom of your screen, there should be like a text box button that you can press, and you can type in any questions that you want, and we'll go over all of them at the end. So
thank you, Jessie.
We'll go ahead and get started.
So the title's all about interest rates, and it's about interest rates are going up, and they're going to go up, I believe, substantially. And we're going to talk about why they're going up and things that people should do regarding their investments and their lives regarding this interest rate increase that we're experiencing. But the cause of the interest rates going up is because of inflation, and that's the government's really only legitimate viable response to inflation is to increase the short-term interest rates, and then longer-term interest rates go up. And somebody might think that interest rates going up, I mean, if you're a CD buyer and all you do, and you're stuck on CDs and all you're ever going to do is invest in CDs, as interest rates go up, you're going to make more money on your CDs, right? But the problem is that those interest rates on the CDs are not going to stay ahead of inflation. And inflation is the problem. Do you think anybody has any doubt on whether there's inflation going on right now or not?
I don't think so anymore. I think enough of us experience day-to-day inflation on all the things that we normally buy, and have been all throughout the last year to realize that it's here and that it isn't transitory.
Well, yeah, gasoline, groceries, anything, you know, I had a new garage door opener put in the other day. I was shocked at how high it is. Anything building materials, houses, cars, everything is going up and going up drastically. And the cause of this, what's caused this inflation is the government printing all this money, just creating money out of thin air. And so when you end up having too many dollars chasing too few goods and services, then the prices go up. And like I said before, the government's only tool to fight inflation, which the Federal Reserve has already been indicating that they're going to start raising interest rate and easing printing this money soon, is to raise interest rates. And so this happened before. When did this happen before, when we had really high inflation?
Back in the 70s and 80s.
Yeah.
I think in maybe early 90s. I don't think we've had inflation like this. I was looking up since I was born, since like 1990 or 1991.
But we experienced in the 70s and 80s, and we've got a chart showing that we'll throw on the screen here, showing what inflation. And on this chart, it's real simple. The red line is the inflation rate, and the green line is the interest rates that went up afterwards. And it just shows you there, you know, that inflation got up to around 1980, got up to around 10%, and the federal funds effective rate was, you know, around then it was 17.5%, and then it got up to just under 20%. And long-term rates follow that too, follow this Fed funds rate and the short-term interest rates. And I remember long before you were born, when I bought my first house, I think it was 1984 or 1985, I got a home mortgage interest rate of 8%, and I was thrilled. It was a 30-year fixed rate on my mortgage. I was thrilled to get 8%. Well, 8% is unheard of now. But the reason I was thrilled was because mortgage interest rates prior to me getting it at 8, a year or two before, were up in the 12% plus range. And so 8% seemed like it was a really good deal. Well, we're going to see that again as these interest rates go up, as the government tries to fight inflation by raising interest rates.
So what should investors do if they know that inflation is here and if they know that interest rates are going to go up? What can they do to protect themselves?
Well, great question. I guess I want to say, if you know, well, we do know, I mean, if you buy anything, you know that inflation is here.
Mm-hmm.
And the inevitable result of the inflation, folks, is rising interest rates. So it's inevitable that interest rates are going to go up. So I've been telling our clients as they come in, and I've met with some of them that are watching the webinar right now, but many haven't heard this presentation yet. There are three areas that you should not have money in, and 3 areas that you should have money in to protect yourself against inflation. Let's talk about the 3 where you should not have money, 3 places where you should not have money when you know inflation is coming, is here or is coming. One is cash, and I'm including savings and checking and money market accounts in cash, because you're just going to lose your buying power and you're not making any interest on them. The second is CDs. Again, because you're going to lose buying power and you're not making any interest, and the rates haven't gone up yet, and they won't go up. When they do start going up on CDs, they won't go up faster than inflation at first. And then the third thing place you don't want to have money is in bonds, because even though bonds right now may be paying a little bit higher interest than CDs, say 3 or 4% on a 10 or 20-year bond, there's an inverse relationship between interest rates and bond prices. Because bonds, it may be a 20-year bond and you invest whatever, $10,000 today, 20 years from now, you get your $10,000 back. In the meantime, you get your interest, fixed interest, like clockwork. Also, in the meantime, though, you can sell that bond for its fair market value anytime. But it's kind of like a teeter-totter, an inverse relationship between interest rates on this hand over here and market value over here. Well, we're at historical low interest rates anyway right now, and they're inevitably going to go, they're going to eventually go up anyway, but they're inevitably going to go up because of this inflation. And as the government raises interest rates, market values of bonds are going to go down. And people that own bonds or bond funds are going to lose money, and they're going to be very unhappy about that, of course. They're going to lose more money on the market value of the bonds than the interest rates that they're getting from the bonds. And the problem is when they go to sell the bond, they're going to sell the bond at a loss, and then when they reinvest at a higher rate, it's not going to make any difference. That's why there's this inverse relationship.
So a tricky place that when you meet with people a lot, and I'm in appointments with you, that we find that people have bonds that don't realize that they have bonds,
right?
Is in their 401ks, in the target funds in their 401ks, which appear to be mutual funds, but they're bond mutual funds. Can you touch on that a little bit?
First off, there's stock mutual funds and there are bond mutual funds, and then there are funds that are made up of both. And that's what a target fund is, whether it says target or not. So you can typically identify that a fund is a bond fund in your 401k by if the word bond is in the description of the fund. But many of these popular 401k funds now will have it'll either use the word target or they'll just have a year in there. And the years usually are in 5-year increments, like the 2020 fund or the 2025, 2030, 2035, with the idea being that they encourage people to put money in there, whatever year fund it is, and that's going to be the year of their retirement, with this kind of old-fashioned philosophy is that as you get closer to retirement, you should have more bonds. Well, I don't care if you're close to retirement or retired right now, you should not have bonds if you think know that interest rates are going to go up, because the bond prices are going to go down. So something that we find a lot in these reviews with people of their 401ks is that they have the Vanguard 2035 fund. and they think that that's a safe, balanced fund, that sort of thing. And what they end up finding out is they have 30–40% of the money in that fund of their money is in bonds. And maybe they didn't intend to be in bonds. Maybe they didn't know that bond prices are going to go down and they're going to lose money in that fund when interest rates go up. So that's a watch out. So anyway, those were the three areas you shouldn't have: cash, CDs, and bonds. There's three investments that are better places when that more hedge against inflation when you're in a high inflation environment. First off, before I go into the first one, what would you say your definition of inflation is, or our definition of inflation?
Our definition of inflation has been the rising cost of goods and services.
That's right, the rising cost of goods and services. When I tell people that's my definition, pretty much everybody says, yeah, that's inflation, the rising cost of goods and services. Well, my favorite, and I think the best place to protect against inflation is to own the companies who are producing and selling the goods and services whose prices are rising. That makes sense to me and most people. And you can own them as individual stocks or mutual funds or ETFs or sub accounts or whatever. But companies are a great hedge against inflation. Of course, you have to be diversified, buy the right companies, all that kind of stuff, pick the right investments. But in general, companies that produce goods and services whose prices are rising are a great hedge against the rising cost. And they're going to appreciate in value equal to or greater than the prices that are going up. The second category of investments that is a good hedge against inflation is real estate. It's an asset, a hard asset. Companies are assets. Real estate are assets that go up in value with inflation. Real estate goes up in value with inflation. We've already been experiencing that with home values and farmland, and the way that it hedges against inflation is both the real estate asset itself appreciates in value, but also if it's like farmland or rental real estate, the farmland is going to produce commodities that are going up in value, or it's going to produce rent if you're renting it out, and the rent's going to go up in value. Rental real estate, the rent goes up. So companies and real estate are great hedges against inflation. And then the final one, and it's kind of my least favorite right now anyway, is commodities, particularly like gold and silver, or gold. Gold is a great hedge against inflation, but it's not the time to put all your eggs in the gold basket yet. The stock market is going up. It's going to keep going up. If something were to happen to the stock market and there was going to be a big drawdown in the stock market, a lot of the big money is going to go to gold, and then gold will go up. But right now, shouldn't have very much. Some of our clients have up to 10% of their accounts in gold. But so companies, real estate, and gold are the good places to put money and have money invested when there's a rising inflation and high interest rate environment.
So what are some other wise things that people can do apart from investments when they know that interest rates are going to rise?
Well, and I'll go into that, but I was just reminded, I've had a number of people in the last, 6 months that I've met with or talked to on the phone that have told me they have a lot of money in the bank. And for some reason, it seems like a lot of people come in and they say, well, I have $100,000 sitting in my checking account. It's a lot of money. And they don't know what to do with it. They're kind of fearful. So people, when they get kind of fearful about what's going on politically and what's going on in society, they kind of hoard money. So hoard is not the right word, but they feel like hold on to it, keep it in the bank. And I've urged them to do something with that money, because that $100,000 that you have sitting in that checking account or whatever it is, let's use 100 as an example. The CPI just came out and it's kind of lagging. And it's over 6% now. Inflation, the last 12 months of inflation is over 6%. If inflation, let's say, is 10% next year, the $100,000 that you have in your bank account is only going to buy $90,000 worth of stuff next year. So buy stuff you need. That you don't put off purchases that you might otherwise have put off for a year or two, when it's going to cost you 5 or 10 or whatever percent more in a year to buy it, like appliances, like automobiles, like a house or something like that. They're just going to be more expensive later. So another thing that people have talked to me about when they come up and they have some, and they come in and they have money in the bank is, should I pay my house off early? And the first question I ask is, what is your interest rate on your house, on your mortgage? And they'll tell me, I've got it down to 2.75 or 3% or 3.5%. Well, no, you shouldn't pay off your house early if you have a low interest rate. And most everybody by now has refinance. So if you don't have a low interest rate on your house, long-term mortgages are still at very low rates, and people should refinance their house. If you have something you want to do your house, like a remodel that you're thinking about doing in a year or two, pull out some money, do a cash out refi, and do that remodeling job now while the prices are lower than they're going to be a year or two from now. And while you can lock in the interest rate at a low rate of 2.5 or 3% now. When interest rates go up on mortgages, and new mortgages are going to be, 8 or maybe 10% or in higher double digits, you're going to feel like a genius having a 3% mortgage that the bank is stuck with for another 30 years. You're going to be able to take your extra cash after interest rates go up and go put it in the bank in a money market or a brokerage money market and get 5% on money market rates again, or higher rates even on CDs and bonds. So that's the overall strategy that I've been advising people to do. The concept, when you're borrowing money, the lowest interest rates and the best terms are on mortgages, long-term mortgages, 15 and 30-year mortgages. And so my philosophy, when you can rent money, because that's what you're doing, is just renting that money from the bank. When you can rent money at 2.5 or 3%, which is what it is right now, for 15 or 30 years, practically rent as much of it as you can, because interest rates are going to go up, and whatever you're buying with that money, whatever asset you're buying with that money, whether it's companies or real estate or even gold, is going to go up at a rate higher than the interest rate that you're paying to rent the money.
I guess another thing that I think we're going to touch on is what happens to the stock market eventually because of high interest rates.
Great. Well, thank you for reminding me. So right now, the stock market has a lot of what I'm telling people, tailwinds that are pushing it up. But the economy opening back up after the COVID lockdowns, and we're still experiencing the positive effects of Trump's corporate income tax cuts from 35% to 21%. They haven't been risen back up, and I don't think they're going to get risen back up. And if so, if they get increased, they're not going to get increased by very much. Technology was already helping companies become more efficient, but because of the forced use of technology with Zoom meetings and DocuSign and all that kind of stuff, companies are becoming more efficient and lowering costs. And as they're lowering costs, that's increasing their profits. As companies increase their profits, their market values go up, their prices go up. So there's a lot of things pushing the stock market up. The only real threat to the stock market kind of is the government. And politically, I don't believe that the government is going to get much done that's going to harm the stock market for a while. That's where I feel right now. But as interest rates start going up, and it'll be a while before they get up very high where it's starting to affect companies, because most companies borrow money at one time or another. Right now, that cost of borrowing money is real low to them. So when interest rates go up, the cost of borrowing money for these corporations goes up too. And so that's going to reduce their profit a little bit, and that's going to take a little bit of the wind out of the stock market. Also, as interest rates go up, some investors, if they can get 5%, let's say guaranteed, 5 or 6% guaranteed at the bank or in a bond or something like that, they might be less likely to be willing to invest in the stock market. So there's two reasons that rising interest rates will slow down the stock market, but that's not going to happen for a while. Right now, probably the best place to be to protect somebody against inflation and rising interest rates is to be invested in companies in one form or another.
Well, I think that wraps things up for us today. I'm going to see if there's any questions. If you have any that you want to type in here in the next 10 seconds or so, go ahead and do that. Otherwise, if you have any questions later, you can email us or give us a call. We'll be happy to help you. Oh. Looks like we've got one here. What about international company stocks, be it China or Europe? This is another place where we see another type of investment that we see hidden in people's 401ks.
Yeah. And interestingly, that's a great question, but we were talking about these target funds earlier, where it's the Target, the Vanguard, Target, or whatever, Fidelity, whatever company it is, Target 2025 or Target 2030 fund. When you look into them, oftentimes they have a very high allocation to international stocks, like 20 or 30%. And it's shocking. Somebody thinks that they're in this semi-conservative 2035 fund and that 25% of their money is invested internationally. Generally, international stocks are much more volatile and much more risky than domestic stocks. That's generally. Right now, my recommendation to our clients has been not to be invested in any foreign stocks or foreign mutual funds, foreign international funds, any of that whatsoever. And it's because of kind of a macroeconomic philosophy, let's say, that, and I can just ask you this question, ask the person that asked this question, do you feel like capitalism is expanding or contracting outside the United States? If you think that capitalism is expanding in China or Europe, the country, what he put in that question, then that's good. Then that would be a good place to invest money. If you think capitalism is being reduced, then you shouldn't invest there. And I think that right now capitalism is not expanding outside of the United States. It's contracting, largely because of all of the COVID lockdowns and that kind of stuff. And so I think the safest place to invest money in companies is in the United States, particularly in larger companies, maybe some mid caps. But that's a great question. Thank you for asking it.
It looks like that's all the questions that we have.
Well, good. Thank you for the question. And we thank you all for attending and listening to the webinar. If you have any questions, you can call us or email us at bob@bobbenny.com or jessie@bobbenny.com. We're always willing to help you in any way we can, answer any kind of financial questions, whether it be about retirement income planning or your investments or estate planning, any of that. Please let us know how we can help you. Thank you very much for watching, and Merry Christmas.
Merry Christmas.